One really important example of how fair market value and adjusted basis can be very different is with real estate. In general, real estate tends to appreciate over time, meaning that its value goes up. If you buy a house sitting on a lot of land today, then 5-10 years from now, it should be worth, in terms of the fair market value, more than what you originally paid for it. However, if you're using that piece of real estate as a rental property, you'll take depreciation expense against that piece of property. The day you paid for it, that was the fair market value, and that was also your initial adjusted basis in the property. However, over time, the fair market value appreciated or increased, but you took depreciation expense against your initial basis in that piece of real estate. So the adjusted basis goes down. 5-10 years later, when you choose to sell this piece of real estate, the fair market value has increased, but your adjusted basis has decreased. Probably to the point to where you'll have a substantial gap between those two numbers. When you sell that piece of real estate, you'll sell it at the fair market value. From that amount, you'll subtract your adjusted basis in that piece of real estate. That gap will then be the capital gain.